Hello and welcome back. CPI numbers come out yesterday. I'm sure that the Bank of Canada is extremely happy about it. 2.9% was the reading for the month of January. That is down from December. Matt, if you can pull up a chart for us, it'll show this beautiful trend of taking us from the highs that we had reached to where we are right now. The one thing that kind of continues to worry everyone is how much shelter costs are contributing to the CPI number. That's not going to change anytime soon. It's not going to change because Canadians still have to renew mortgages, and that will continue to feed in to the year-over-year increase in the cost to service their shelter. So we saw rents skyrocket because of the demand for housing in Canada. We continue to see mortgage servicing costs increase simply because of the way mortgages in Canada are structured, right? Like we don't have 25 and 30-year mortgage terms. We have, on average, 5-year mortgage terms. And that means that Canadians who had really great rates 4 or 5 years ago are now renewing into really high interest rates. The contribution on that last CPI report was 6.2%. 6.2% year-over-year increase in the cost of shelter, and that is being driven by how high interest rates are. The good news here is that bond yields are dropping. If you remember last week, everyone was frantic because the bond yields were climbing higher because of an inflation reading out of the States, showing that inflation was still running hotter than expected. Again, this whipsawing in the marketplace because we're seeing that Canadian inflation is running less hot than expected. We see bond yields react. We're going to continue to see this. I don't think we are going to kind of walk right out of this with continually lower and lower inflation numbers. There's still going to be scares to the upside that result in bond yields hiking. There's still going to be language from the Bank of Canada that scares the market into thinking that rates will be, again, higher for longer. They've been saying this for a while now. I'm going to go back to what we said in September of 2023. It feels like forever that we've been talking about this. I said that David McKay, CEO of Royal Bank of Canada, said that in June, rates are going to drop. And I hold firm to that. In June of 2024, rates are going to drop. If you look at the number of people that have now kind of hopped on that bandwagon, Trudeau yesterday announced that he hopes to see rates drop sooner in 2024. Go figure. Anything probably to help him now with a hope of re-election. Certainly debt servicing costs are impacting Canadians, which is going to impact how they vote in the next election. I don't know if anything can change the way that they're going to vote based on how beaten up they are financially right now. Maybe you can answer me that in the comments. We got a great number out for CPI. That number reaffirms that the Bank of Canada's tightening is working and inflation is coming down. It also highlights just how much of this inflation is being driven by shelter costs, a little bit still by food costs. And if you look at that StatsCan report, you can see food, although the amount that it is contributing to the CPI has reduced 5% from December of 2022 to December of 2023. And now 3.9% from January of 2023 to January of 2024. So that's a good sign. I looked through this. There was one funny thing within the food. They break food down into subsets. One of the highest month over month and annual inflated prices within food was like confectionery and sugars. If you look it up, sugar hasn't inflated that much. I just find this so strange, right? The input prices have not increased 10%. It's just another example of like big corporations finding ways to use greed to inflate prices. We're on our path to lower interest rates. I think we're going to see a bit of a spring market. We've seen support in real estate prices. We're going to continue to see that. Great thing for, homeowners. If you're renegotiating a mortgage right now, we're seeing this so much, which is kind of bothersome, where people are dealing directly with their banks and their banks are encouraging them to take fixed rate products right now. I can't overstate this enough. Your advocate for your mortgage needs to be you. It cannot be the person that is dealing with you at the bank. They're advocating for how the bank can make as much money as possible. They don't care how much you're going to save on your mortgage. That advice does not come from an unbiased place. So anybody that's telling you right now, lock into a fixed rate mortgage is leading you down the wrong direction, because the likelihood that interest rates spike further from here over the next, whatever the term you're looking at, 2, 3, 5 years, is so low, so minimal. It would take some massive resurgence in our economy. Bank of Canada keeps talking about housing prices. I think that they've come to grips with the fact that they're not going to be able to affect any meaningful change anymore on housing prices. And for sure, that's an issue for them. It's like a rallying cry for everyone. There's just not enough supply. And as a result, housing prices are sticking where they are. Canadians are holding on. They're managing their payments. So good job. Canadians are smart. They see that rates are coming down. Look for this inflation report to create some type of a response. It already has in bond yields. It already has in the CDOR market. We looked at the CDOR market last week on the show. Inflation numbers from the United States last week impacted the CDOR market's probability that the Bank of Canada was going to drop rates this year, and when and how. And now this most recent CPI number from Canada, which we got out yesterday, already impacted that CDOR market. That is to say, the likelihood of a rate drop for June of 2024 was over 100% certainty. And when you look at that CDOR TMX chart, the way that manifests itself in the chart is it shows a probability of a 50 basis point drop. So when you see now on the chart that it's saying there's this 9%, when I last looked at it, it was 9%, but there's a likelihood of a 50 basis point drop in June, that's just telling you that the market's pricing in a more than 100% certainty of a 25 basis point drop in June. So unlikely that we're going to see 50 basis points in June. Nobody's counting on that. I think that if you want to play this, timing the strategy, I think that between now and June, the probability of that rate hike will continue to change. There's a chance we don't get that 25 basis points in June. If that 25 basis points doesn't come in June, I think that the response, the consumer confidence, the consumer spending, that response over the successive months, so the July and August responses, will put the nail in the coffin of high interest rates, and then will result in the rate drops that we've been waiting for. And I hate to say it, like, I don't know what the probability of that happening is. But again, if we're talking about central banks in the G7 nations, Canada, which is one, who are all on this concerted effort of eliminating inflation because of what that does to economies, what it does to societies, clearly there's a mandate. So if we are to err on the side of caution, there is a chance that June doesn't bring that rate hike. I think that it's a small chance. If rates stay sticky, if the Bank of Canada doesn't drop in June, it is an absolute certainty we are going to see significant drops into the fall and winter of 2024, and obviously more normalized rates for 2025. Like low probability, but possible, just because of the verbiage, just because of what we're getting out of the central banks around all of the G7 nations right now about this kind of higher for longer and stamping out inflation. It becomes kind of so widely held by the consumers of all the G7 nations that rates are going to be lower in June, and everyone starts behaving as though they're already lower. That impacts our market. That psychological effect of rates are going to be lower in June almost acts as rates have already gotten lower. And then if June is this surprise that, oh my God, rates aren't lower, the whipsaw effect on the consumer's confidence, on the consumer spending will be so pronounced. It might be the thing that the Bank of Canada and the other central bankers are waiting for to start on their path of actually meaningfully reducing borrowing costs for consumers of all of the G7 nations, not just Canada. We are fortunate because a lot of countries are in worse shape than we are. Like their inflation readings are hotter. Their economies are far more impacted from a consumer spending and consumer confidence. This kind of just speaks to the whole misery loves company. Listen, this was short and sweet today. I just wanted to get this information out. Hopefully we can get it into your inboxes. If you're a newsletter subscriber, please don't forget to subscribe and hit like. And again, if you have any questions about what's happening in the market or you want us to cover a different topic, leave it in the comments. Thank you very much.